Gold fell 17% since the war started. Everyone is asking the same question right now. Why is gold going down in the middle of a world war? That question is the most important one you can ask, and the answer changes how you should be positioned for the next 30 days. Here is what actually happened this week. We are on day 32 of the conflict. The IRGC formally declared the Strait of Hormuz closed to any vessel heading to American, Israeli, or allied ports. That is not a threat. That is active policy. Over the weekend, the U.S. struck Karg Island, the terminal that processes 90% of Iran's oil exports. The Houthis in Yemen launched ballistic missiles into Israel, opening a fifth front in a war that started as a two-sided conflict. And this morning, an Iranian strike hit a Kuwaiti oil tanker in Dubai waters. Trump has now set a hard deadline, April 6th. If Iran does not reopen the strait and accept the core terms of the peace plan, the U.S. will destroy Iran's power plants, oil wells, and desalination infrastructure. Without desalination, a country in the desert has no drinking water. That is not a negotiating threat, that is an ultimatum. And Iran's new supreme leader, Khamenei's son, issued his first public statement saying the strait stays closed. So why did gold fall? Here is the mechanism. Gold already priced in the war before it started. It ran 24% higher between December and February. When the missiles started flying, the premium was already in the price. What nobody expected was this. With the strait closed, emerging market central banks, the biggest buyers of physical gold on the planet, had to sell gold to buy energy, to defend their currencies, to pay for oil that tripled in price overnight. At the same time, the dollar got stronger and treasury yields moved higher. Those two forces push gold down in the short term. This is not structural weakness, this is forced liquidation, and there is a massive difference between someone selling gold because they stopped believing in it and someone selling gold because they need dollars right now. The second scenario is temporary. Now, here are the two scenarios going into April 6th. Scenario 1, a deal gets done. I give this 40% probability. Iran reopens the strait, oil falls back below $100, the dollar pulls back, gold recovers fast toward the 4,700 to 4,900 range, and then the structural trend resumes, because a ceasefire does not erase $1 trillion of new U.S. debt every 100 days. Scenario 2, escalation. I give this 60%. Iran holds firm. Trump strikes the energy and desalination infrastructure. Oil goes to $150, $160. Inflation goes to systemic. And in that environment, gold decouples from the dollar entirely. Fear overrides the yield mechanic. That is the 1979 setup. Everyone who studied that cycle knows what happened to gold after. The structural case has not changed. Central banks are buying record volumes of physical gold. U.S. debt is compounding at a pace that has no historical parallel. Goldman Sachs has a 5,400 target. J.P. Morgan is at 6,300. None of those numbers look aggressive if the strait stays closed for another 30 days. Watch April 6th. That is the real inflection point. If Trump extends the deadline again, Iran reads it as weakness and hardens its position. If he strikes, oil explodes and gold remembers what it is. And if a deal comes through, gold pulls back short-term, but the long-term trend does not change. Which scenario do you think plays out? Drop it in the comments. I read every single one.